News Radio 740 KTRH.
Give me an idea as you look at this thing. I mean, it's common for taxpayers to wonder, whether or not they're going to be audited. I get audited usually every other year. I've been going through this for a long time. They just don't care for me. But that's not the case for most people, right?
No, it's really not. I mean, if you're getting audited every other year, I don't know what to tell you. Typical odds are going to be under 1% for most people.
Okay.
Now, there's certain things that, certain business entities and income levels and all this that can raise those odds, but still in general, they're low, and even more importantly, they're probably going to be going lower. The IRS is making budget cuts. This is not something where they're increasing their workforce. Okay,
so that's good to know. And for me, I think being a conservative and being on the radio, and hopefully that'll go away now. So we'll see what happens. But at any rate, it is also important to kind of get things done properly. So if you were to give me a list, say, of maybe the top 3 or 4 things that it's really important that you do. I mean, if you want to keep the IRS off your back, make sure you at least got this in.
Right. So, if you were just going to look at 3 or 4 things, well, one is when you're looking at things like mismatched forms. So know that the IRS gets a list of everything that you get, they get as well. So when you talk about 1099, W-2, all these items, stay organized, make sure that you submit all these documents. There's nothing that you're getting that they don't know about. So that's a flag that shows up if they get your tax return in and one of those pieces isn't there. Mm-hmm. That definitely can increase the chance that they start looking closer into your returns. Okay. So that's a big important piece is mismatched deductions or mismatched forms. And the other is, they have bands for saying, okay, how much are you making and then how much are you writing off? What kind of deductions are you taking? So if somebody's making $50,000 versus $500,000 in income, they're going to have different levels of deductions. And if you're outside of that range, they're going to start taking a closer look, which is not the end of the world. If you moved and you have more charitable deductions because you're giving stuff away, that's fine. Keep really good records. So that's not the end of the world. And then pieces like your home office deduction, right? So that can start to raise your chance a little bit. Keep in mind it's exclusive and regular use as a principal place of business. So, you see clients all the time. They're not really sure how to write this off. So as you're navigating those waters, make sure you know what you're doing and you're using the right numbers. You know what?
You're absolutely right about that one because I have a studio and I've had it for almost 10 years in my home. And, I use it a lot. I use it every single day. I mean, it's where I work. But again, you've got to present that correctly. And so in situations like that, I would assume, Kyle, that the best thing to do is to get an accountant, get somebody that knows and helps you and walks you through that. Don't guess.
Yeah, guessing is typically not the best way to go. The IRS has allowed, at least on the home office deduction, a more simplified method where if you say, well, I think it's going to be pretty low anyway, so they're going to allow you to take, it's a pretty low number, but if you've got a higher number and you're going to be digging in a little bit on writing off different levels of home expenses for the home office deduction, it's probably a good idea to get some help. Less time that you have to spend, and it keeps your tax returns buttoned up.
All right, you're a good man. All right, give me 3 or 4 real quick foolish write-offs. Never do. Go ahead.
Foolish nothing that if you're doing, let's say, a really high deduction, really high charitable deduction without any sort of documentation.
Bad news.
That's bad news, right? All right. Anything charitable, they say, hey, that's great. Go ahead and show us. And for that matter, any sort of large write-off or large deduction that you don't have paperwork, charitable or not, just don't do it, right? If it's that large, you're going to have some sort of paper trail for it. So the IRS is going to want to see that paper trail.
Right.
If you start, anything that one of your friends told you is a really great idea can be dangerous. Typically, the better it sounds, the less likely it is.
The worse it probably is.
Yeah, I mean, so if you think one of your friends knows something that nobody else does, that's highly unlikely. So it's time to stay away from the water cooler. Keep things between the lines and keep all your documents, and you'll be just fine.
Well said, my friend. Very, very well said. Financial and tax strategist Kyle Walters joining us this morning. Well, thank you. And if I get into any trouble, I'll give you a holla.
You got it.
Well, here's a wonderful thought. It's tax season again, and we'd all like to avoid an audit. We're still under old tax law. Experts say there are steps you can take that'll maybe keep the IRS from your door.
Tax strategist Kyle Walters says make sure your deductions are proportionate with your income.
If you're making $100,000 and you have deductions of $90,000, that's obviously a proportion that can be a little out of whack.
Walters says one of the biggest mistakes that'll lead to an audit is failure to report income.
If you get a 1099 and you're getting something in the mail and you don't report that, the IRS has got technology in place. It's going to let them know that you didn't report it.
Walters says, bottom line, if you're honest, there's no reason to fear an audit. Scott Crowder, News Radio 740, KTRH.
It's expensive to go through one, though. No one wants an audit. Tax strategist Kyle Walters says you can probably avoid one if you report all income and you're careful about the proportion of your deductions to your income. But he says over the decades, well, your luck could run out.
Audit doesn't necessarily have to be such a bad word, but keeping in mind that this is something that can happen. And if you file, when you file your taxes every year, even if it's a low probability, you file your taxes for 30, 40 years, it's probably going to happen.
Yeah, IRS says fewer than 7% of all returns are audited.